After a stellar 2025 in which emerging market equities returned to 34%, 2026 is off to a good start, with the MSCI Emerging Market Index up 7% year to date. This week, we highlight 5 reasons why we've warmed up to emerging markets. First, the dollar looks like it wants to go lower. The U.S. dollar index is on the cusp of breaking a long-term uptrend. Further weakness could potentially introduce 5% downside or more from a technical analysis perspective. Second, the earnings growth is accelerating, and AI is a big reason why. In 2026, emerging market earnings are expected to grow 29%, more than double the current earnings growth expectations for the U.S. at 14%. Third, the exposure to the AI boom in Asia. And what may be a surprise to some, the MSCI Emerging Market Index has as big an allocation to technology as the S&P 500 at slightly over 30%. Not only is emerging market a play on AI, as China has made advances and is well positioned to benefit from the new technology, but much of the AI chips and hardware needed for AI data centers actually comes from Asia. Fourth, technical analysis trends are compelling. And fifth and finally are attractive valuations. Now at a 40% discount, emerging market valuations remain compelling. If this is the start of a long cycle in emerging market, current valuation levels may allow for substantial additional outperformance. If you have any questions about the stock market or your investments, contact us at Oxford Capital.